Hi, everyone. I welcome you to our discussion on this topic, which is Interim Financial Reporting or IFR, represented by Ind AS 34. Friends, this is another disclosure standard, and I would want to say that this is a mini version of Ind AS 1, the presentation of financial statements that we had studied, in the initial conversations, right? Now, the very idea of this standard, and this is a small standard, of course, to talk about, and a lot of stuff that we have studied under Ind AS 1, presentation of financial statements, is all being discussed here again, but at a more frequent level, right? When I say more frequent level, I mean to say that where Ind AS 1 is talking about the annual reporting, okay? Ind AS 34 actually talks about interim reporting, which is more frequent than annual, right? And when you say you're looking at a more frequent or an interim reporting, you're talking about when you're preparing the financial statements for a less than one accounting period, which is 1 year, of course, right? So what is all that we do as far as the interim financial reporting is concerned? What are the kind of statements that we prepare? Are we still required to prepare a balance sheet, a statement of profit or loss, a statement of changes in equity, a statement of cash flows and disclosures? Well, the answer is yes. But then, is it going to be as detailed, as descriptive as it was in case of Ind AS 1? The answer is no, right? Somewhere we want to use the term condensed financial statements when we look at this particular standard. Okay, so let's try to understand it further as a part of the introduction, where we talk about, of course, why the need of interim financial reporting and how does it actually work in practical life. Okay, imagine you are a shareholder in a company, or you are any user for to look at the financial statements of a company. Okay, let's name that company as company X. Okay, and it prepares its financial statements for the year ended 31st of March 2020, right? It would also be required to prepare the financial statements for the next year, let's say year ended 31st of March 2021. Okay, so between these 2 years, or between these two dates, 31st of March 20 and 31st of March 21, okay, let's even take another date here, right? This is, let's say, 31st of May 20, and let's call it the date of authorization of the financial statements. Okay, now we may argue that as and when you are preparing these financial statements, let's say for the year ended 31st of March 2020, there could be some events that can take place between this reporting date and, of course, the date of authorization, right? And of course, as covered under Ind AS 10, which addresses the need for the events after the reporting period, right? That addresses the need for any such event. So they would all be either disclosed or shown as a part of the adjusted financial statement. That's something that we have talked at length under Ind AS 10. Okay, so they are being addressed. There's no problem at all. But the other aspect that starts coming is that in case anything that happens during this period, let's say post the date of authorization and up to the date of year end, which is ended 31st of March 21, if something happens, how do you deal with that? How do you address that part, or when do you report that? Okay, so effectively that reporting would happen in the subsequent year, right? So for the sake of argument, again, if I say something happens on 1st of June 2020, and if I'm only preparing my annual reporting year, okay, if I'm only preparing my annual financial statements, effectively, I only get to know about it in the next year, right? When that company is issuing these financial statements, which would be a fairly or a considerably longer period in between. Okay. And that is where the need to have interim financial statements came. That's where the need to have these interim financial statement arose. Okay. We are talking about now that an entity should prepare its interim financial statements, which address the reporting requirements if it pertains to a period of less than one accounting period. Okay, in India, there is a requirement for listed entities to prepare these statements on a quarterly basis, right? There is no such compulsion on the private companies, so they might want to use that periodicity to report it on a quarterly basis or even a half yearly basis, as the case may be. But in case those companies decided to prepare their financial statements for the interim period, then Ind AS 34 becomes applicable, right? Ind AS 34 would address the manner of presentation of financial statements and the minimum disclosure requirements. Okay. Now, this is exactly the same wording that we had used under Ind AS 1, but Ind AS 34 is a little relaxed kind of a standard for us in terms of working on the presentation and the disclosure requirements. The requirements of presentation and disclosures are not very extensive. They're not very detailed. It's condensed, as we used that word a while ago, right? That's something which basically this standard is trying to address, that there is a need to present these financial statements for the reporting period, which is for a less than 1 year of accounting period, right? And that's where this standard becomes relevant there. Okay. So when we talk about these aspects, the need for the standard would be talking about, for example, what is the meaning of this interim financial report? When are entities required to prepare such reports, and what reports are included? And I would say it's all comprising of a balance sheet, statement of profit or loss, statement of changes in equity, statement of cash flows, and selected notes, right? Only the material items need to be disclosed, and that's how it is. And for example, again, it talks about significant events, how they need to be recorded, and the principles for the recognition and measurement thereof. Okay, it's a small standard, again, focusing on that, and there are very specific areas that could be tested. So it's a conceptual standard, since it's all about disclosure. So we don't expect accounting entries to be involved, but we not need to understand the standard, from the perspective of the presentation and disclosures, and that is something which is again sought after as a part of this particular discussion. Okay, when you look at the objective and the scope of the standard, it talks about the minimum content that the financial statements must carry, and of course the principles for recognition and measurement for those condensed financial statements. Now, it also refers to the word complete financial statements, right? Entities are given a choice. Entities are given a choice to use either condensed, which are precise information, or complete set of financial statements, which are, of course, detailed information. Of course, any company would prefer to use a condensed information given a choice, right? So the condensed statements would again talk about the minimum content of those interim financial reports there. That's how you start looking at the relevance of this particular standard. Okay. Effectively, as we said before, that interim reporting is not mandated by the standard, but it is encouraged, and it is largely driven by the regulations, right? For example, the Companies Act would require the quarterly reporting to be done by the listed companies, as we said before, right? So the standard would not really issue that guideline in terms of which entities should be required to prepare these financial statements and how frequently, for that matter. Okay. And how soon after the end of the reporting period. The whole idea is that nothing is driven from the standard, but the only idea is that if you are preparing those interim financial reporting, which could be quarterly or half yearly, for example, right, then the requirements of Ind AS 34 is there in terms of how should these set of financial statements be prepared by the entities. Okay, right? So when you look at this entire perspective, there are specific definitions that we need to be comfortable with. Interim period is a period shorter than full accounting year or full financial year. And interim financial report means a financial report carrying either a complete set or a condensed set of financial statements for the interim period. Now, importantly, you also want to remind yourself is that there could be, let's say, if I talk about the full accounting year, we are referring to, of course, starting 1st of April. Let's look at the year, 2020 and 21, right? So it starts from 1st of April 20, ends on 31st of March 21. This is my full or complete financial year. Okay. Now, importantly, what do you want to take into consideration if, for example, there's a company which started its business, okay, let's say on 1st of June 20. Okay. It is incorporated on 1st of June 2020. Of course, its year would be up to 31st of March 21. Okay. Now, while this is a period shorter than a full financial year, we cannot refer for this company, right? We cannot refer this as an interim period. Okay. So if it's preparing the financial statements for 1st of June 2020 to 31st of March 21, this would be addressed under Ind AS 1 and not under Ind AS 34. You need to bear it in mind. The interim period is reflected as a period shorter than full financial year. It is not saying anywhere that it has to be a quarter or a half year. Okay. So please be very, very open and very comfortable about the definition. Okay. So a company, for example, which is in the first year of operations may see a period shorter than a full financial year. It would still be looking at Ind AS 1 as far as its part of financial statements are concerned. Okay. Similarly, there could be another entity. So if I again take those dates, 1st of April 20 to 31st of March 21, and this company is dissolved on, let's say, 31st of December 20, right? Which simply means it is only required to prepare the financial statements up to 31st of December 20. This is still covered by Ind AS 1, no matter the period is shorter, right? Shorter than, of course, full financial year. All right. So what do you normally see? What I'm trying to kind of highlight here is that when you look at the initial year or the start year, or let's say at the end of the life of the entity, right? In those cases, you would see that a full financial year is not exactly the entire 12 months of period, right? It could be a shorter period than that, but that is not to be, defined as an interim period. Okay. That's something that you want to pick up purely as a concept. You need to understand this definition well. Okay. Again, highlighting that you have a choice to either prepare a complete set or a condensed set of financial statements as far as the interim period is concerned. Okay. Right. Now, when you have got this interim period, okay, And we simply use the perspective of quarterly reporting. Okay, simply use the perspective of quarterly reporting. We are preparing those balance sheets, statement of profit or loss, statement of changes in equity, statement of cash flows, and importantly, select explanatory notes, right? Specific explanatory notes, right? Of course, significant events, right? So what is the periodicity that we need to cover? Okay. Now, of course, we understand that the balance sheet is always as on date. Okay. So the periodicity, if I were to look at my year end date, so my whole year is my complete year is starting 1st of April 20 to 31st of March 21. And I'm looking at my current period, let's say my quarter one, right? So my balance sheet has to be as on 30th of June 20. Okay. Which is any which ways the balance sheet as on date, right? And also when I prepare my balance sheet for the current period, there is also a requirement to prepare a balance sheet of the previous annual reporting date. Okay. So that would be, of course, 30th of June 19, right? So my interim reporting date and the preceding annual reporting date, my bad, has to be 31st of March 20. So that comparable figure has to be provided there. Okay. But as far as my P&L is concerned, I need to do an additional effort. I need to prepare two sets of P&Ls, which are basically from 1st of April 20 to 30th of June 20, right? And it's also required to have an YTD period, which is, by the way, the same. Okay. So effectively, as far as the first quarter is concerned, I'm only required to prepare one statement of profit or loss. And also, I would be preparing the comparable statement of profit or loss as far as the previous year's same quarter is concerned, right? So this is my Q1. Okay. As far as my statement of changes in equity is concerned, it's a YTD, is a single statement. So from 1st of April 20 to 30th of June 20. And this would also be the comparable period, 1st of April 19 to 30th of June 19. The same goes with the statement of cash flows. So 1st of April 20 to 30th of June 20 and 1st of April 19 to 30th of June 19. As far as the events and disclosures are concerned, all those things which pertain to this particular periodicity, that would obviously be reported, and also the comparative information for the previous year. The moment we come to the quarter two, right? The quarter two expects us to prepare, let's say, a balance sheet as on 30th of September 20. Okay. That's where you start looking at it. But the moment you look at the statement of profit or loss, now we are talking about 1st of July 20 to 30th of September 20 plus 1st of April 20 to 30th of September 20. So it's not only the interim period, but also the YTD period, right? Only the quarter one, we are looking at one set of statement of profit or loss, but quarter two, quarter three, and quarter four, we shall have two sets of statement of profit or loss for the same accounting year, right? As far as the quarter is concerned, and then of course, the YTD, year to date information, and a comparable information. So this was the Q1. When we look at the Q2, we are talking about 1st of July 19 to 30th of September 19. And then we are also looking at 1st of April 19 and a YTD performance, which is 30th of September 19. Okay. And then this is something which is straightforward, 1st of April 20 to 30th of September 20. The same case with the statement of cash flows, right? And comparable periods also, 1/4/19 to 30th September 19, 1/4/19 to 30th September 19. So this is Q2, Q1 information, right? Something that you want to just remember as a concept. And this is the same thing which is also taken forth, right? It's also taken forward for the Q3 as well as Q4. Okay, just to highlight those aspects in terms of how does it work as far as the periodicities are covered as far as the interim reporting is concerned. The balance sheet, statement of profit or loss, statement of changes in equity, statement of cash flows, and select explanatory notes, right? So all those dates are provided, and then we're looking at specifically something which relates to the statement of profit or loss, where we have a far more fetched information to be provided there. Okay, right. Now, when you look at the form and content, again, the standard is very clear about it that if you're preparing a complete set of financial statements, religiously follow Ind AS 1. You don't have a choice, right? So even if it pertains to a interim period, doesn't matter. You follow the requirements, the form, content, the information that is required as per Ind AS 1, you need to follow that. However, if you prepare a set of condensed financial statements, then you need to include the headings and subtotals included in the most recent annual financial statements and additional line items or notes. If you believe that would be desirable. If you don't disclose those, then it can create some misleading information, right? Now, what does it mean? How do you read that part? We are saying that simply, I'm looking at my balance sheet, for example, as an assets, right? My primary heading is assets, and then we have non-current assets. Okay, so we are saying that this heading of non-current assets has to be, of course, presented not just, of course, in the full-fledged set of financial statements, but also under the condensed financial statements. Now, within the non-current assets, we have a list of property, plant and equipment, goodwill, other intangible assets, financial assets, deferred tax asset, and likewise, we may have investment property, for example, and stuff like that. Similarly, there would be another heading, which is current assets. And then I'm looking at, of course, my inventories, trade receivables, for example. Then we have, financial assets again. There could be, short-term, I don't know, it could be advances, just in case they don't meet the, criteria of financial assets. So all these things, so they would all be reported as a part of, on the face of the balance sheet there, right? That is something which is the reference of the headings and subtotals there, right? So all these headings would be a part of any which ways, the interim financial reporting as well. And so is the case, by the way, when you look at, your statement of profit or loss, we'll have revenue in place, you have cost of goods sold, you would have gross margin or a gross profit, you would have a list of expenses, you will have, of course, your profit before tax, finance cost, tax expense, and profit after tax, and the other comprehensive income for that matter. So you bring all these, headings and subheadings all as a part of your interim financial statements as well. Okay, so that's how you start building it. And for each such reporting period, you any which ways required to prepare also the basic and the diluted EPS calculation. You show that as, again, on the face of, let's say, the statement of profit or loss. Okay, right. Similarly, look at the entity's annual financial reporting, right, which also includes the separate financial statements, right, apart from the group financial statements. So that is something which is not neither required nor prohibited as far as the preparation of those statements are concerned. So effectively, when we deal with the group financial statements, there would be a concept of separate financial statements for the parent, right? In case the annual financial reports include those, right? The statement is not, this particular standard does not expect you to be, looking at a preparation of the interim financial reporting form from the separate financial statements perspective also. But then it is desirable to prepare that as well. Okay, right? That is something that you wanted to kind of, again, bring as a part of the context when you look at this particular standards requirements. All right. Now there would be, again, as expected, as desirable, as relevant, any significant events and transactions which take place, and that's probably the reason why, that's probably one key reason why this standard is there in existence, right? So you need to explain any significant events which are likely to impact or change the financial position of the performance. I mean, something that can impact the numbers presented on the balance sheet or on the statement of profit or loss, that need to be explained in detail, right? That would include whatever has happened and update the relevant information as presented in the most recent annual financial report. The easiest example you could think of is, there could be a contingent liability, right? Let's say sitting on 31st of March 20. Okay, of course, you would be disclosing that. All right. Right. There could be a court case against, as an example of a contingent liability, right? So you know that there is no present obligation, so you continue to disclose everything about it. For the quarter ended 30th of June 20, there's a further update that, for example, if it pertains to a penalty, just for the sake of argument, we are putting it, for the sake of understanding, we are doing this. Let's say there could be a penalty of 50 crores, which was expected to come, but then this penalty has been further enhanced to, let's say, 65 crores. Okay, nothing is becoming a present obligation as yet, but now, while my report for the year ended 31st of March 20 referred to that penalty amount of 50 crores, right? The interim report ended 30th of June would update this to 65 crores. Okay. And let's take a step further. Say, for the sake of argument, for the quarter ended 30th of September 20, this is becoming a confirmed liability. Right? This is becoming a confirmed liability of, let's say, 60 crore rupees, just a number, doesn't matter what the number is, right? So what I was trying to say is that you update that event and transaction, right? Whatever has happened so far, you now need to update that, which simply means you will recognize an expense of 60 crores and also, of course, a liability to the extent of 60 crores during this quarter, between 1st of July 20 to 30th of September 20, right? You need to recognize this as your additional expense because it pertains to, let's say, a transaction or an event that took place before, but the measurement is only done, or measurement has only happened during this particular quarter. Now think of the consequences. In your quarter one, there is no impact, right? But in the quarter two, suddenly there is an expense of 60 crores arising in your books, right? Nothing needs to be done. You have to follow it the same way because that is where the standard expects you to do. All right. Okay. Now this could be, of course, a lot of examples. I think we just took one of those cases like a litigation settlement case, but then any aspects including write down of inventories or the reversals, impairment of financial impairment of financial assets or non-financial assets and the reversal of that, any provisions or reversals of provisions with respect to the restructuring, any acquisition disposal of property, plant, equipment, any commitments entered, any errors being corrected, right? Anything that impacts the fair value of the financial assets or liabilities, etc. Further, you can talk about also instances like related party transactions, any default of loan, etc. Right? Any movement between different level of hierarchies. We study under Ind AS 113 there, and any changes in the classification of financial assets, etc. Similarly, changes in the contingent liabilities or contingent assets, they all would be significant matters. So they need to be updated for each such reporting period per se. All right. Now, this could be a very straightforward thought process where you look at the recognition and measurement part, where we say that just follow the way you had been doing the accounting for the entire accounting period. You're still following the accrual concept. You're still expected to follow the prudence, right? A principle, you're looking at the matching aspects, etc. So all those aspects of accounting policies, conventions, rules, principles, an entity shall apply the same accounting policies in its interim financial statements as applicable to the annual financial statements, right? Unless there is a change made in the accounting policy itself. Okay. The frequency of the reporting, be it an annual reporting or a half yearly or a quarterly or anything else, would not allow any changes in the measurement criteria, right? That's the reason why when you look at the measurement, it is done on a YTD or a year-to-date basis, right? Which probably may mean that there could be some estimates that may change. You could be looking at an estimate with respect to the life of the asset or the salvage value of an asset, or let's say a warranty provision. But then that would remain consistently the same as you do it as far as your annual financial statements preparation is concerned, right? Purely conceptual, but it has a lot of relevance in terms of when you prepare these financial statements. When you grow, when you grow farther in your professional career, when you go to industry, take a job, or even as a practicing chartered accountant, when you do these auditing, then you need to follow all these aspects. That are these appropriately followed by the entities or not, right? Similarly, in case there are costs which are incurred unevenly, right? There could be a business cycle, for example, right? So there could be peaks and lows. You need to be very, very careful about it, that even if these costs are uneven, right, they can only be what do you say, they can only be recognized over the period uniformly if that is appropriate to do so, right? You cannot, for example, bring a cost, let's say, so there could be some cost that you are supposed to incur. It could be a salary cost. You might be paying to your staff, and let's say you're operating a hotel, for example, at a hill station. So that there is a peak season, there is also a lean season, right? So if you're paying salaries there to your staff even during the lean season, it doesn't mean that it has to be parked into the peak season, because that is where the revenues will be higher. No, you cannot get away with, or you cannot compromise with the matching and the accrual concept both, right? So accrual would have a role to play here, right? So even if the costs are uneven because of the cyclical nature of business, or a seasonal business for that matter, so you can only pick them up if it is appropriate to do that. But otherwise, accrual is the key. Accrual follows the way it is meant to be, right? That is something that you want to pick up as a part of this conversation. All right, we'll be now talking about the specific cases as far as the preparation of interim financial reporting is concerned. All right, thank you very much.